Today, we'll be delving into the conditional value at risk portfolio optimization approach. We'll be using resources from the Finance ResearchGate website for our discussion. However, before we dive into the practical applications, I need to take a moment to clearly lay out the underlying theoretical framework first. Now, when we're considering portfolio optimization, the primary objective within any portfolio typically involves two key components: the expected mean return and the associated risk. So in this specific scenario, we are looking at the portfolio's overall return. And then for this other section, we have this particular section covers the concept of portfolio variance. For instance, do you understand how this specific equation operates? Let's consider a scenario where we possess two distinct assets. Our initial asset yields an annual return rate of 1%, while the second asset provides a return of 2%. This return could be calculated annually, or perhaps monthly, or even daily, depending entirely upon the frequency of your available data. And let's assume that we have this variance covariance matrix. The variance of the first asset, it is 4%. The variance of the second asset is higher. And the covariance is positive, and its value is 1%. The gamma value here indicates the level of risk aversion. So if you have higher risk aversion, you will penalize the risk more as measured by the variance. So for example, if you have two assets and you're going to invest 50% in each, the calculation would then work out like this. First, simply multiply the weight by the return for each individual asset. Then you'll determine the variance covariance matrix. You do this by multiplying the variance covariance matrix itself by the weight initially. This effectively means you are weighting both the variance and the covariance terms. And then you proceed to multiply by that same weight once more. Consequently, what you end up with is the weight squared. And once we have the variance of the portfolio and the expected return of the portfolio, we then simply plug those values in here. This calculation is just the return minus the weighted variance, where it's weighted by the risk aversion, which is measured by gamma. In this particular case, we are assuming that its value is 3, and that is not the final number. The fundamental idea behind portfolio optimization is that we continuously adjust the weightings of the assets in order to maximize the overall value that we see here. For instance, if we were to allocate a greater portion of our investment towards the second asset under the assumption that it would yield a superior return, thereby enhancing the overall objective value of our portfolio, we might proceed with this strategy. However, upon implementation, we could discover that we actually achieve a significantly lower value. So, portfolio optimization aims to find the optimal weight distribution for assets. This allows us to maximize the value of our portfolio objective. Therefore, everything truly depends on how you precisely define that portfolio objective. When we consider the conditional variance approach, the main difference is that the portfolio objective itself will be formulated quite differently, and it will take on a specific structure. So, the first part of our approach remains exactly the same as it was before. We are still focused on maximizing the mean return, but the second part of this calculation is now quite different. We are no longer making use of the variance as our primary metric. Instead, we're now employing a measure known as the conditional value at risk, or CVaR. And this is precisely how we can effectively define the concept of risk. The CVaR, or conditional value at risk, is essentially a robust measure of the worst possible financial outcome. Therefore, in order to fully understand and explain the conditional VAR, let's now proceed with this illustrative numerical example. Let's consider that we have only 5 distinct possible outcomes. Each of these is equally likely to happen. So, pause. Now, the letter L here signifies a loss. So, a minus sign actually means it's a gain, because you see, a minus loss inherently means a gain. So, we're looking at a range of possibilities here. The most favorable result, the best outcome, shows a gain of 2%. Other positive scenarios include another 2% gain, a 1% gain, or even breaking even at 0. However, the most unfavorable situation, the worst case scenario, involves a significant loss of 10%. Therefore, we can effectively sort all these potential results from the very best to the absolute worst, and our primary focus will then be directed towards analyzing the 20 most undesirable outcomes. We first need to define the Greek letter alpha. This value essentially reflects the specific portion of a given distribution that we are comfortable accepting. For instance, if we set alpha to 95%, it implies that we are comfortable with the best 95% of all observed data points. Consequently, the remaining portion, which is 1 minus alpha, represents the part of the distribution that we are not comfortable with. In this specific case, that would be the bottom 5%. Now, let's consider applying a different numerical value. Alpha is set at 0.8 or 80%. This means that the worst 20% of all observations or potential outcomes are those we are not comfortable with. This specific situation is what we refer to as tail risk. Our objective is to avoid and minimize the worst 20% of all possible outcomes. So presented here, we have the concept of value at risk, and then over here we have the conditional value at risk. The value at risk, specifically at the 0.8 level, indicates the smallest possible value where the cumulative probability of reaching it is 80%. This particular value is 0.01 or 1%. This implies that if we consider a distribution of potential outcomes or values, then the worst thing happened. A 20% level is something that we definitely want to minimize and avoid. The smallest value, which once we manage to reach it, will then cover the worst 20% of all possible outcomes, is precisely this figure, 0.01. Smaller than this point, we're looking at less than 20%. So when we find the smallest possible value that makes this area exactly 20%, we then refer to this as the value at risk. In this specific case, it's 0.01. The conditional VAR looks beyond the cutoff. So if we are in the worst 20% of cases, what is the average loss? So if we arrive at this particular point, what would be the average loss incurred? There's also a probability of experiencing the worst 20%. However, what is the precise amount of that potential loss? In this particular scenario, the loss will be exactly this amount because it would encompass 20% of all the observations, given that we have only 5 possible and equally likely outcomes. Consequently, the conditional value at risk, which represents the total amount of loss in this specific situation, is exactly 10%. So, in this particular situation, our objective is to carefully reinsert this specific numerical result we've obtained back into the established mathematical formula precisely at this designated point right here. And that would be the conditional value at risk, which is the primary measure of risk that we are specifically aiming to minimize. So if you possess an asset that exhibits a high conditional VAR, it logically implies that it will most probably be assigned a lower weight within our portfolio because our methodology is designed to heavily penalize any assets showing higher values of this conditional value at risk metric. So, for instance, if we possess 2 distinct assets, let's call them asset A and asset B. If we then make the decision to concentrate our entire investment, that is 100% solely on asset number 1, what then would be the calculated conditional VAR for that specific scenario? It would be 10%. However, if you were to distribute your investment by dividing it into 2 equal halves, then you would need to multiply each individual outcome by 1/2 and this other portion by 1/2 as well. And then you would determine the final value. If we consider and examine each individual situation, then the associated conditional value at risk will be found to be quite substantially lowered. And if we were to apply or even reapply this equation once again, we might find that this specific portfolio or its weighting would prove to be much better because the resulting conditional value at risk is now significantly reduced. Indeed, it's even more substantially lower by well over 50% when compared to the original situation. So once we've successfully plugged this equation back into our framework, we then systematically adjust and change the portfolio weights until we pinpoint that particular weight that will effectively maximize our portfolio's overall objective function, which importantly now includes a penalty for the conditional value at risk. So with that understanding, let's proceed to apply this entire concept using the tools available on the Finance ResearchGate platform. To begin, you'll first need to navigate to the time series section.
Let's use a monthly frequency for this.
Now, for the ending point of our data range, we're going to select the year 2024. Then we'll go ahead and apply these settings to all the relevant charts that we're currently viewing. Regarding Series A, it's important that we keep that particular data set open and readily accessible for analysis. Following that, we should initiate a search to locate 2 distinct corporate entities. Specifically, the company we're interested in finding is ExxonMobil. So I'm going to pick 2 firms, then build a portfolio based on conditional VAR. Let me quickly refresh the page and do the selection again. Stage. First, we need to select the metric before we choose the firm. This way, we ensure we have the list here. It's crucial to understand that the sequence of these actions is quite significant. First, we must carefully choose the specific variable we intend to analyze. Only after that can we proceed to begin selecting all the relevant stock tickers. For instance, this would involve searching for a company like ExxonMobil. Its corresponding stock market ticker symbol is XOM. Once you've entered it, simply press the Enter key. And then you'll select the first firm from the list. We also want to select an additional company. For instance, let's choose Coca-Cola, which has a ticker symbol KRO. Finally, you'll hit Enter. So we'll search for the right company, and now we've identified 2 potential firms from which we can effectively construct a portfolio. It's time to apply all the necessary filters. And to ensure clarity, we should proceed with renaming this particular data point to accurately represent the average return for both KO and Exxon.
And then our next important step would be to build a portfolio.
We're going to be using precisely the same two firms. Consequently, let us allow the entire system to take into account any and all weight considerations. We are completely comfortable with utilizing these weighting factors, provided that they ultimately lead us to the most effective and optimal solution possible.
We will not be permitting any short selling activities. Instead, we'll focus exclusively on long-only positions. For our estimator, we have chosen the minimum conditional VAR, which is the value at risk.
And then we are going to define the specific number of periods over which we will estimate the key parameters. Specifically, in this particular analysis, these include the average return and the conditional value at risk. It's important to note that we are not using the full data sample, which spans from the year 2000 up to 2024. Our current approach involves a cycle of every 24 months. Therefore, with each passing month, we initiate a new cycle, repeating the entire process to determine the optimal weights and construct the investment portfolio. Consequently, we propose to rebalance the portfolio on a monthly basis. You have the flexibility to adjust these parameters right here should you wish to do so. Alternatively, you could even choose to construct a portfolio utilizing the entire available sample period spanning from the year 2002 all the way through to 2040. However, I much prefer to utilize a rolling window, allowing us to update the information on a truly continuous basis. Following that, we then proceed to run the portfolio backtest.
It's important to observe that the initial pre-configured default value was precisely 0.95.
If you are looking to avoid the most severe or extreme outcomes, you have the option to reduce this parameter even further, specifically down to 0.8. This particular value represents the absolute minimum threshold that is available for selection within the system. Consequently, choosing a lower numerical value for alpha directly implies a greater emphasis on mitigating these worst-case scenarios. As a result, the overall conditional value at risk will inherently be reduced. So, you will be getting a portfolio with significantly improved results during the worst-case scenarios. All right, let's rerun this calculation, setting our alpha value at 0.8. This means that 1 minus alpha will then be 20%, and that specific value will then serve as our critical cutoff point when we are defining the extent of the potential tail risk. What you see here represents the portfolio's weighting for every single month. As I've already explained, we conduct a full rebalancing and roll over all positions each month. For instance, looking at the recent past, you'll notice a clear inclination in our holdings towards Coca-Cola, particularly during this current time frame. However, we also maintain a substantial position in ExxonMobil. Ultimately, our goal is to ensure we achieve the highest possible return while minimizing the conditional value at risk. And these are the portfolios for each and every month that are designed to provide the best objective outcome. Once we have completed this, we will then be able to compare the overall success achieved. If you simply implement an equal weighting strategy as demonstrated in this particular scenario, you will obtain a mean monthly return of just 0.5%. However, by employing portfolio optimization techniques designed to maximize overall returns and simultaneously minimize the conditional value at risk, the average return achieved is significantly higher. The standard deviation is somewhat close, but it's still noticeably lower than the conditional VAR. We shouldn't forget that this involves a portfolio with equal weighting, and such equal weighting can also help diversify the risk. But when we're confronted with the most challenging scenarios, it's truly surprising how our unique portfolio course provides much greater insurance and significantly minimizes potential losses. Even if you compare our findings to the most extreme individual scenarios, considering the worst single person or even the worst 5, 10, or 25 individuals, we consistently observe that our overall numbers are substantially lower, particularly when we meticulously evaluate the conditional value at risk. That concludes our discussion for today. Thank you very much for watching.